In 2019, I met with Nicolas, a French entrepreneur. What he pitched me was very new and unique at the time, NFTs to bet and collect on soccer players. Remember, we're in 2019, NFTs are not a thing at all. And so while I believe in the founder, I don't believe in the project or the product he's going after, and I decide to pass on this pre-seed investment. This company is obviously Sorare. 2020 brings COVID, everyone's locked at home, and people become crazy about NFTs. Sorare become the biggest French unicorn with a $9 billion valuation just a few years later. The 150,000 euros allocation that he gave me at the time and that I turned down would have been worth, at its peak, more than $200 million that I lost, potentially, by not investing in Sorare. This has been famously for the last few years one of my biggest miss. I even did a previous video on that very topic on my French YouTube channel, now discontinued because I publish here every week in English. So please don't forget to subscribe if you're new to this channel. Thank you very much. But then last week, a friend of mine sent me this article. Sorare is on the brink of collapse. So I want to emphasize that the company is not dead yet. The article says that the founder is hoping to bring revenues back up and to keep building an amazing and thriving company. But still, it made me pause and wonder about what we call our failures and what we call our successes. And it made me wonder about success in the startup world. How come some startups make it and stay at the top over the long term? And what happens when startups become unicorns and are all the rage, and then a few years later go extinct? And so that's what I want to talk about with you today. How to protect your own startup if you're a founder from going extinct and going to zero after reaching the top. If you're an investor, how to detect those potential startups early on so you can avoid those paths as well. The first thing I want to say is that Sorare was clearly built on top of a trend, the NFT trend. They were ahead of the trend because, again, remember, he was already building this in 2019 when we met. But now that the trend is quietly going away and less people are interested in NFTs, then it is a big problem for the company. Now, again, I don't want this video to age poorly. So maybe in 5 years, NFTs are back. There are some interesting characteristics about NFTs. But right now, 2025, I'm making this video, very few people care about NFTs. People care about AI. People care a little bit about fintech, blockchain, and stablecoins. People don't care about NFTs. So if your company as a founder or your investment as an investor relies on a huge trend, including AI now, you're at risk that whenever the trend goes away, then your company struggles. People might be saying, well, AI is a different trend than NFTs, and that's because AI has a much bigger, profound impact on society, on businesses than NFTs do. And I would agree with that. NFTs have very few real-world application, solve very few problems, where AI is already solving millions and millions of problems. And as AI becomes better, it's going to get to solve more and more and more problems. So that's a big difference, but you have to recognize that ahead of time. In 2021, when NFTs were all the rage, many people thought NFTs were here to stay and to stay forever, and they weren't. Today, people think AI is here to stay forever, and maybe it will, maybe it won't, but how do you know in advance? That's what being a good investor or a good entrepreneur is, in my opinion, is trying to project the future. Obviously, you can't really know the future for sure, but try to map and to have the best idea possible in your mind of what the future is going to look like. Another lesson to grab from this: if you are an investor and you have a company surfing on a trend or not that goes from a pre-seed to a 9 billion valuation in 3 years, you should probably take some money off the table. You don't have to sell everything, but you should probably take some money off the table on the secondary market. If your company goes from 0 to 9 billion in a few years, there is going to be a lot of demand, and smart investors should take some money off the table, giving you an amazing return and keeping a position as well, so that if the company 10x's again, you still have some upside. And that's something that I really learned over the years as an investor, when I was a much younger, inexperienced investor, my idea was ride the wave until the end every time. Many times it is a good thing to do when it goes well, because most of the value will come at the very, very end. But investors, your LPs, are going to need to see DPI for you to give them money back as early as possible. And this is going to help you doing secondaries on some good startups. But also, as this story shows, unicorns are not necessarily forever. It's very interesting that many people think that when a company is big, it means it's immortal. And I'm just talking unicorn and startup world, but it happens in the stock market as well. People think Google and Amazon and Tesla are going to be here forever. And that's not true. There's plenty of examples of worth tens, if not hundreds of billions of dollars that went to zero. We can think of Nokia, we can think of Motorola, we can think of Nikon, the photo and picture company that actually invented digital photography and ended up going to zero, or Kodak, maybe it's Kodak. So there's so many examples of huge companies going to zero. So a big company is not immortal, and you have to know how to sell and when. It's a good thing because it aligns with the interests of your investors who want liquidity. So I've really changed and evolved over time. And in the case of Sorare, obviously it would have been a very smart move to sell at the time of the hype. Of course, we only know after the fact, but that's why you usually take some money off the table. And then finally, it gave me a lot of perspective on what we call a success, what we call a failure as an investor. Of course, we want to have amazing startups become unicorns and give a lot of money back to your investors. But if I was invested in Sorare and if I didn't sell, then I would have had something that looked like a success for many years, and then that would have collapsed. So the lesson for me here is what matters is money back in your pocket. Those virtual valuations don't matter a lot. And in this world of VC, we rely on those valuations a lot. So we end up thinking they're real, and they're not. The real value is what someone pays for it at the very end. So an intermediary valuation when you have zero money in your bank account means almost nothing. And that's why liquidity is king. That's why cash is king. You have always to think about and focus on liquidity. And that's a very, very good and valuable lesson for me. For so many years, this looked like the big failure, the one that got away that I missed. And today, it looks much better. I want to conclude this by saying, every time you have something like this, you do a post-mortem of why did I say no at the time? Should I change my investing philosophy, my investment criteria, or was I right in hindsight? And I did this in my video on the other channel that I published a few years ago. And my conclusion at the time was I took the right call. I should not change my investment philosophy. And that's not to say I will catch every unicorn, just to say that this is a very lucky breakout. No one could have predicted NFTs and COVID in 2019. So I was right, according to my philosophy, to not invest, and I shouldn't change my investment criteria. That's what I concluded at the time. This recent development tends to make me even more correct there. But even if the company ends up being a huge exit, you have to be able to say, I'm not going to change my philosophy for every good investment I miss, because it's also random and chaotic. You're never going to catch every good investment. So that's another thing that we do as VCs, and that you should do if you want to become a better investor, is the companies that you invested in and did well, analyze them and figure out why. The companies that you invested in and failed, try to figure out why. But also the entire portfolio, the companies that you didn't invest in that are doing really well. And sometimes you will find patterns and need to adjust your investment criteria, but it's also as interesting and important to understand when you should not change your investment criteria because of an entire portfolio company doing great. All right, I'll leave you with this. Thanks for watching until the end. If you've liked the video, please give it a like, a subscription to the channel. You can turn on the notification bell. I publish every week, taking you behind the scenes of the VC world and the YC ecosystem. Thank you so much for watching. See you next week. Bye.